superstars, welcome to the channel. This is the place to learn accounting. I've got great ways to show you how to learn accounting. I've been doing this for 30 years. I'm a professor and a CPA, been doing it forever, and I've got fantastic ways to explain it to you. So hang on. Today we're going to do financial statements for the very first time. And what I did is I boiled this down to its essence. I made it as simple as possible, so that way you'll get the general idea. So what we have to do first before we can do financial statements, we have to have some transactions. So here's what's going on. We've got Fred's snowblower service, and Fred is just now today starting his business. A brand new business. This business hasn't existed until this moment. So Fred gets into a savings account and he gets $5,000, and he puts this $5,000 into his brand new business, Fred's snowblower service. Now this $5,000, we've got it on the left. We have to have something on the right here to keep our accounting equation in balance. Now Fred doesn't owe anything on this $5,000. And so what we're going to do, we're going to put it here as equity. There we are. And I have a label here on the right hand side. We're going to call this an investment. Fred is investing money into his business. Now next, Fred here has to go to the bank and get some more money because $5,000 isn't going to be enough money to start this business. So he goes to the bank and he borrows $20,000. So $20,000 are coming into the business, and Fred owes this money. He's going to have to pay it back. It's an obligation. So here we go. It's a liability. Now, every time we have a transaction, we have to make sure that the accounting equation balances, and I think it does. Look at this here. Assets. I got all this on this side here. In fact, I've totaled it up here. 25,000 total assets. Liabilities total up to 20 grand. Equity 5,000, and so 20,000 plus 5,000 is 25,000. So we're good here. Looks good. Well, let's say, wow, on the very first day of Fred's snowblower service, a customer walks in and needs his snowblower repaired. So let's say that Fred does the job, gets the work done, and gets paid, and he is paid $300. So I've got $300 here under the assets. I need to have $300 somewhere here on the right hand side. Now this is money that Fred has earned. It belongs to Fred. He did his work. And so I'm going to put it under equity. Now I labeled this $300 revenue. And a very good definition for revenue for us right now today is revenue is money coming in from doing his job. So this is money coming in from Fred doing his job. That's a very important distinction. It's probably way more important than you may realize at this moment. So revenue, money coming in from doing your job. Let's say that Fred here has a part-time assistant worker, and his worker earned $50. Fred is paying his worker $50. Now I'm putting this as a negative sign because this is money going out. You see, when Fred invested cash, that was money coming in. When Fred borrowed money, that was money coming in. When Fred performed work, that was money coming in. So these are all listed as positives. But when money goes out, Fred needs to list this as a negative. Now we've got a negative 50 on the left. We need to have a negative 50 on the right. And Fred does not owe this money. He paid his worker. His worker has been paid. So we're going to put negative 50 under equity, and we're going to label this as an expense. Now I told you a moment ago, revenue is money coming in from doing your job. Expenses is money going out from doing your job. Money going out from doing your job. Going on, let's say that Fred here, he's going to have a clarinet lesson. He loves to play that clarinet, and he probably plays jazz or symphonic music. Who knows? But let's say Fred's clarinet lesson is $15. And let's also imagine that Fred doesn't have any money on him, so he takes $15 out of the company's cash account. So he's spending $15 out of the business's cash account. Now that's negative because it's a cash outflow. And he doesn't owe anybody this $15. It's his money. And so we're going to put it here under equity, negative 15. And we're going to call that a withdrawal. So if you probably notice here, expenses and withdrawals are negative. Expenses, as we said here, that's money going out from doing your job. A withdrawal, that's money going out, but for personal reasons. A big distinction. On to the last transaction. Let's say that Fred's got to pay back a little bit of money on that loan. Let's say he's got to pay back, $35, just to keep it nice and even here. And let's say that this is going towards the loan principal. Where no interest here. We're keeping things simple. So here we go. So what's going on here? Fred is paying back the loan, and by paying back that loan, he's reducing the amount of the loan. See, he borrowed $20,000 and he paid back $35,000. So now he owes $19,965. There we go. So we have all of our transactions complete. We are done here, and it would be a great idea to make sure that this accounting equation balances. It's always good to double check before you go on. So on the left we have 25,200. On the right we have 19,965 and 5,235. And I would bet you anything that if we added those two numbers together, it would equal 25,200. And it looks like it does. Yeah. Okay, we'll find out when we do our financial statements. So this is the exciting part. This is where we do our financial statements for the very first time. This is exciting, and this is the absolute essence. I don't think I could make this any more simple than this. So hang on, and I'm sure you'll get it. So I labeled these statements. There's 3 of them. I have number 1, income statement. Number 2, changes in equity. Number 3, balance sheet. And I labeled them 1, 2, and 3 on purpose because you have to do them in order. There's no way to do them out of order. They flow. They flow like a river flowing towards the ocean. Also what I did too is I highlighted net income here in yellow, and over here in changes in equity, I highlighted in yellow. And the reason why is this net income number is going to get transferred over here to changes in equity. I highlighted in light blue ending owner's equity, and that number is important because it's going to get transferred over here to the balance sheet. And that is why you have to do these statements in order. It doesn't work if you don't do them in order. So here you go. Revenue, that's money coming in from doing our job. So where do we find that? Well, what you do is you have to look at your transactions, and we have $300 of revenue. This is money coming in from doing Fred's job. So $300, there we go. And expenses, that's money going out from doing Fred's job here. So we have a negative 50. We have to look at our transactions to find it. Negative 50. So I'll put negative 50 here. Net income. Net income. All what net income is the difference between revenue and expenses. So in this case, it'll be $250. So another way to look at this income statement is money coming in and money going out from doing our job. This 250 is going to get transferred over here to the changes in equity, and we'll transfer it when we get to it. Let's start at the top here. Statement number 2, changes in equity. What we do is we start with beginning equity. So if you recall from the beginning of this story, Fred is just this month starting his business. His business has not existed before. This is the very first month. And so his beginning equity was 0 at the very, very, very beginning, before he did anything. Now the next step here in this equity statement here, this changes in equity, is that we're going to add any owner investments. And Fred did invest some money into the business, $5,000. So we'll write that down right here. There we go. And then we're going to add net income. Where do we get that from? Well, we figured it out right over here. $250. So it just gets transferred over. And then less any owner withdraws. Well, Fred withdrew $15 for his clarinet lesson. So we're going to put that down here. It's going to be a negative 15. Negative 15. There we are. And so let's total this up and see what we get. Grand total. There we go. $5,235. Check this out. This is not a coincidence. We have $5,235 here and $5,235 here. They match, and they're supposed to match. They will match. So that's a good way to double check. So let's go to the statement number 3, the balance sheet. The balance sheet is my favorite statement, and I'll explain why in a later video. But it's a good statement, and all it is, folks, is the accounting equation. That's all it is. Look at that. Assets, liabilities, and equity. Assets, liabilities, and equity. It's the exact same thing. So all we do is transfer the total assets over to the balance sheet. Well, the total assets is right here, $25,200. So let's put it right here. $25,200. Liabilities. All we're going to do is take the total liabilities and drop them over here. So total liabilities, $19,965. Equity. Now I've got that in blue here. So folks, this equity, we have already calculated it. We're going to get the number from right here. There it is. It also happens to be the total of this column too. So owner's equity is $5,235. There we go. Now all we have to do is add up our liabilities and our equity and get a grand total. And hopefully this grand total will equal the assets. So here we go. So folks, the last thing that we have to do here for this balance sheet is add up the liabilities and the equity. So we have total liabilities and equity. And hopefully that total will equal this $25,200 because this number here represents the right-hand side of the balance sheet. So let's see if it does. And it sure enough does. So total assets, $25,200. Total liabilities and equity, $25,200. Our balance sheet balances, which we would expect because our accounting equation balances. And if we would have made a mistake, we would have found out at the balance sheet. It would not have balanced. And so the only thing that we could do would be to go back and retrace what we did and check our math and make sure that we transferred the right number to the right spot. And that's all there is to it because it will balance. Folks, you have completed your very first introduction to financial statements, and I hope you found it easy. There's really nothing to it. We can go over more examples, but you have to let me know. So leave a comment, let me know what you want to learn. Let me know if you like this video. Let me know if you want me to make more videos. So you have to help me out and let me know how I can help you. Until next time, over and out.